Hello there, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I'm going to analyze Berkshire Hathaway stock and explain why I think Berkshire Hathaway stock is one of the best stocks during a high inflation market or even during a recession. I will talk about Berkshire's biggest competitive advantage and the biggest risks. Also, I will show you how to calculate Berkshire Hathaway stock's intrinsic value per share, so you will know whether Berkshire Hathaway stock is undervalued, fairly valued, or overvalued now. I will give you my overall stock rating for Berkshire Hathaway and explain whether I'm buying Berkshire Hathaway stock now. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog. I've posted a link in the video description. Once you become a Patreon member, you can follow all the stocks I'm buying every month, follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculators so you can estimate whether a stock is undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So why is Berkshire Hathaway one of the best stocks that can benefit the most in a high inflation market or in a bear market? I'll explain Berkshire's biggest competitive advantage here. First, we have to understand Berkshire Hathaway's business model. Berkshire Hathaway is one of the largest investment holding companies in the world. Berkshire owns over 65 companies across many different industries. Berkshire's most important operating businesses are insurance, BNSF Railway, Berkshire Hathaway Energy, McLean, manufacturing, and service and retailing. If you look at these business segment financials here, you can see Berkshire earns the most earnings before tax from insurance businesses, BNSF Railway, Berkshire Hathaway Energy, manufacturing, and service and retailing businesses each year. Because Berkshire owns more than 65 companies, it's not possible to look at all of Berkshire's businesses individually, so we can only look at Berkshire's businesses in different groups. Berkshire's most important business is still insurance. This is because Berkshire's insurance businesses generate more than $164 billion of insurance float for Warren Buffett to invest. A large portion of this insurance float is used to pay off insurance claims each year. This insurance float is very steady and almost cost-free in most years for Warren Buffett to invest until Berkshire needs to pay off insurance claims. Insurance float is considered cost-free whenever Berkshire's insurance businesses have underwriting profit. Insurance float is not cost-free whenever Berkshire's insurance businesses have underwriting losses. Buffett explained this in the most recent annual report. One reason we were attracted to the property casualty PC business was the industry's business model. PC insurers receive premiums upfront and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest these floats for their own benefit. Though individual policies and claims come and go, the amount float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float. Here's Berkshire's first biggest competitive advantage. If you look at this table here, you can see Berkshire's insurance float has now grown from $39 million in 1970 to $164 billion in 2022. The insurance float is the difference between premiums received from policyholders today and the claims that must be paid out to policyholders in the future. During this time, Berkshire can invest its insurance float to earn more interest income and dividend income. Then Berkshire will eventually repay this insurance float back to policyholders at some future date when they file their claims. This growing amount of insurance float is Berkshire's biggest competitive advantage because it lets Berkshire invest in stocks, short-term US treasuries, and long-term government bonds, and even buy out other companies such as Allegheny in 2022. It's almost impossible for other insurance companies to copy Berkshire's insurance business model because most insurance companies can only invest their insurance float in US treasuries, government bonds, and other corporate bonds. Most insurance companies, as far as I know, don't invest their insurance float in dividend-paying stocks like Berkshire Hathaway. Here's an important part about Berkshire's increasing amount of insurance float. We may in time experience a decline in float. If so, the decline will be very gradual at the outside no more than 3% in any year. The nature of our insurance contracts is such that we can never be subject to immediate or near-term demands for sums that are of significance to our cash resources. That structure is by design is a key component in the unequal financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income that float produces. When such a profit is earned, we enjoy the use of free money and better yet, get paid for holding it. For the property casualty industry as a whole, the financial value of float is now far less than it was for many years. That's because the standard investment strategy for almost all PC companies is heavily and properly skewed toward high-grade bonds. Changing interest rates therefore matter enormously to these companies, and during the last decade, the bond market has offered pathetically low rates. Our property casualty companies have meanwhile had an excellent underwriting record. Berkshire has now operated at an underwriting profit for 18 of the last 20 years, the exceptions being 2017 and 2022. In 2017, our pre-tax loss was a whopping $3.2 billion. In 2022, the loss was minimal. For the entire 20-year span, our pre-tax gain totaled $29.2 billion. If you look at Berkshire's latest financials here, you can see Berkshire's Geico had a very large underwriting loss of $1.88 billion in 2022. According to Reuters, this is the 6th straight underwriting loss at Geico. Geico has been struggling with accident claims and properly pricing policies to reflect risk. According to Berkshire, Geico is expected to generate an underwriting profit in 2023 because Geico has successfully obtained premium rate increase approvals from certain states in response to the significant claims cost increases it has experienced in recent years. As I mentioned earlier, Warren Buffett invests a large amount of insurance floats in high-quality dividend-paying stocks every year. At the time of making this video, Berkshire's stock portfolios is worth around $325 billion. Buffett's top 7 holdings are Apple, Bank of America, Chevron, American Express, Coca-Cola, Kraft Heinz, and Occidental Petroleum. These top 7 holdings are all dividend-paying stocks. Apple is the biggest holding. It makes up about 44% of the portfolio. The top 7 holdings make up about 83% of the entire portfolio. Buffett has invested in most of these companies for many years already. Going forward, I expect Buffett's $300 billion plus stock portfolio will continue to grow over the long run because of the large amount of insurance floats that's going into this portfolio every year, and because Buffett has invested in some of the best dividend growth stocks. Berkshire's second biggest competitive advantage is this. At the time of making this video, Berkshire has $125 billion of cash and short-term treasuries. Buffett stated that Berkshire will always hold at least $30 billion of cash equivalents to protect itself from any market downturns or large insurance claims or any unexpected events. Charlie and I have pledged that Berkshire, along with our subsidiaries other than BNSF and BHE, will always hold more than $30 billion of cash and equivalents. We want your company to be financially impregnable and never dependent on the kindness of strangers or even that of friends. Both of us like to sleep soundly, and we want our creditors, insurance claimants, and you to do so as well. This means Berkshire has around $95 billion of cash or war chest to invest in stocks or to buy all other wonderful businesses if prices are right. This is a huge competitive advantage when there are a lot of uncertainties in the market. Warren Buffett likes to be very greedy when others are fearful. He likes to invest in wonderful businesses and stocks at wonderful prices. Berkshire also owns BNSF, which is the largest Class 1 railroad company in the US. Based on what I know, the barriers to entry into the railroad industry are extremely high because of very large capex and high regulations on railroad companies. BNSF has a near monopoly in its railroad network. It's almost impossible for new competitors to duplicate BNSF's railroad network. The second biggest Class 1 railroad operator in the US is Union Pacific. The downside of BNSF's business is that it needs very large capital investments to maintain its railroad network each year. Berkshire has other business groups such as Berkshire Hathaway Energy, Manufacturing, McLean, and Service and Retailing. As a group, I think many of these businesses will perform well over the long run because they are largely tied to the US economy. Buffett said this in his recent shareholder letter. He explained that most of Berkshire's businesses are aligned with the US overall economy, or what Buffett calls the American tailwind. Buffett wrote, "Our 10 control and non-control behemoths leave Berkshire more broadly aligned with the country's economic future than is the case at any other US company. At Berkshire, we hope and expect to pay much more in taxes during the next decade. We owe the country no less. America's dynamism has made a huge contribution to whatever success Berkshire has achieved." a contribution Berkshire will always need. We count on the American tailwind, and though it has been becalmed from time to time, its propelling force has always returned. I've been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I've yet to see a time when it makes sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. Over the past 10 years, you can see Berkshire had fairly consistent revenue growth, operating cash flow growth, and free cash flow per share growth. During the same period, you can see Berkshire Hathaway stock had outperformed the S&P 500 by around 40%. At the same time, you can see Berkshire stock performance is very much aligned with the S&P 500. Going forward, as long as the US economy is doing well, I think most of Berkshire's businesses should perform well over the long run. Also, Berkshire is much larger than before. If Berkshire wants to outperform the S&P 500 over the long run like before, I believe Berkshire will need to buy more elephant-sized businesses that can increase Berkshire's operating earnings and intrinsic value per share. In terms of risk, I think the first biggest risk is Warren Buffett's succession. As of now, I think it's too early to tell whether Buffett's successors will be able to manage Berkshire as well as Buffett. As of now, Greg.A. is expected to succeed Buffett as Berkshire CEO when Buffett is no longer with us. Greg.A. has been the vice chair of Berkshire's non-insurance operations since 2018. Ajit Jain will continue to manage Berkshire's insurance businesses. Ajit Jain has been the vice chair of Berkshire's insurance operations since 2018. Both Greg and Ajit have been with Berkshire for more than 20 years already, so the positive thing is that they understand Berkshire's culture very well. They have been running Berkshire's insurance and non-insurance businesses for many years already. Buffett's two investment managers, Todd Combs and Ted Weschler, will likely manage Buffett's $300 billion plus stock portfolio and invest Berkshire's insurance float in stocks when Buffett is no longer with us. I believe Berkshire's second biggest risk is insurance risk. It is not possible to predict all the large catastrophic events, such as earthquakes and hurricanes in the future. If there are catastrophic events, Berkshire will likely have large insurance claims and large underwriting losses in any given year. This is why Buffett requires Berkshire to always keep at least $30 billion of cash in case of any unexpected events and underwriting losses. If you look at Berkshire's latest financials here, you can see Berkshire has $143 billion of unpaid losses. These unpaid losses will eventually pay out to policyholders in the future, which will take many years. In comparison, Berkshire has grown its insurance float to $164 billion. Berkshire's insurance float will likely continue to grow over time. In addition, Berkshire has $123 billion of long-term debts. In comparison, Berkshire has $125 billion of cash and short-term treasury bills. I think this shows that Berkshire has a strong balance sheet, and Berkshire has the cash to pay off all its debts if needed. Unlike banks, customers cannot go to insurance companies to withdraw all their deposits or to ask for the past premiums they paid. So the good thing about Berkshire's insurance businesses is that there's no bank run. Let me show you how to calculate Berkshire Hathaway stock's intrinsic value per share here, so you will know when Berkshire Hathaway stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I'm using a discounted cash flow model to calculate Berkshire's intrinsic value per share. You can use a sum of the parts valuation model to value Berkshire's intrinsic value, but I decided to use a DCF model here. This is because Berkshire has fairly consistent free cash flow each year. I define Berkshire's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 10% here. You can use a higher discount rate here if you want to be more conservative. Berkshire's most recent trailing 12 months of total value is $302 billion. I expect Berkshire's total value will grow by 5 to 7% compounded annually over the next 3 years. In comparison, Berkshire's revenue grew at a compound annual growth rate CAGR of 6.5% over the past 10 years. According to Second Alpha, Berkshire's consensus revenue growth is expected to be much higher over the next 3 years, so I'm being very conservative in Berkshire's revenue forecast here. Also, I used an estimated free cash flow margin of 7.4% here. This is consistent with Berkshire's free cash flow margin over the past 5 years. Let's go over these 3 case scenarios here. Under the worst case scenario, we're forecasting Berkshire's revenue will grow at a compound annual growth rate CAGR of 5% over the next 3 years. The free cash flow margin is expected to be around 7.4% each year. If we forecast Berkshire's free cash flow over the next 3 years and discount the free cash flow to the present day, Berkshire's intrinsic value should be around $591 billion for the entire company, or $268 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting Berkshire's revenue will grow at a CAGR of 6% over the next 3 years. Then Berkshire's intrinsic value should be around $608 billion for the entire company, or $276 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting Berkshire's revenue will grow at a CAGR of 7% over the next 3 years. Then Berkshire's intrinsic value should be around $694 billion for the entire company, or $283 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Berkshire's intrinsic value should be around $276 per share. I think this is a very conservative number. I also use this price to book valuation method to estimate Berkshire's fair intrinsic value, which should be around $707 billion for the entire company, or $321 per share. If we take the average of both valuation models here, Berkshire's intrinsic value should be around $298 per share. Just to compare, Morningstar estimated Berkshire's intrinsic value to be much higher at $370 per share. This means I believe Berkshire Hathaway is either fairly valued or slightly undervalued at the time of making this video. So here's my overall stock rating for Berkshire. If you look at this spreadsheet here, you can see there are 5 main criteria I always look at when I analyze each company. Under the management rating here, I will give Berkshire an exemplary rating because I think Warren Buffett and Charlie Munger have done an outstanding job running Berkshire for more than 50 years. Under the economic moat rating, I will give Berkshire a Y economic moat because I think it will be very hard for other companies to copy Berkshire's business model. Morningstar also gave Berkshire a Y economic moat. Under the moat trend rating, I will give Berkshire a stable moat trend rating. Under the profitability rating, I will give Berkshire a cash cow rating because Berkshire earns more than $20 billion of free cash flow each year. Under the risk and uncertainty rating, I will give Berkshire a medium risk rating. I think Berkshire's biggest risk is succession risk. I think it's too early to tell now. Overall, I am giving Berkshire Hathaway a stock rating of 11, which is one of my high stock ratings here. At the time of making this video, I don't have Berkshire Hathaway stock in this portfolio here yet. I will likely buy Berkshire stock in this portfolio in the upcoming months if Berkshire is slightly more undervalued. Personally, I want at least a 10% margin of safety before investing in Berkshire in this portfolio. I actually have Berkshire stock in a separate growth stock portfolio. I bought it at a much lower price a few months ago. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intrinsic channel, and I will see you in the next video.